Hello and welcome to this episode of BizTalk. I'm Lulu. Following two suspected interventions by the Japanese government, the yen experienced a recent rebound, temporarily reversing its previous rapid decline. On May 13th, the Bank of Japan's reduction in long-period bond purchases once again brought the trend of the yen-dollar exchange rate into global focus. And today, we're joined by Mr. David Scutt, Senior Analyst from Gain Capital, and Stephen Innes, Managing Director of SPI Asset Management, to jointly discuss the effectiveness of the Japanese government's recent interventions and the potential impact of U.S. monetary policy adjustments on the Japanese yen. So first of all, Mr. Scutt, what does the Bank of Japan's reduction in its bond purchases, especially in the 5 to 10-year bonds, reducing that amount by 50 billion yen. What does that mean?
It caught markets a little bit off guard, but it's just that incremental steps towards potentially another rate hike coming through. I know that when you look at current market pricing, by July this year, there's around about a 70% chance of another 10 basis points hike being priced in. When you look at that, the bond buying reduction is just one of those steps towards that particular path. Slowly but surely, but heading towards policy normalization.
And what sort of impact do you think you would anticipate on the financial market in Japan due to this measure?
Look, a slight reduction in bond purchases is not likely to go and do too much when it comes to financial markets. It's more what it signals from the Bank of Japan and the outlook there. If we do go and see a follow-up rate hike coming through, which wasn't priced in all that long ago, you might start to go and see some impact on the Japanese yen, some of that curtailment of the weakness that's really impacted the Japanese yen over recent weeks. At this point in time, we're seeing that bond yields are drifting up. 10-year JGB yields, 5-year JGB yields are now trading at multi-decade highs. So the markets are moving towards and pricing that realistic outlook at this point in time. As yet, though, we still haven't got that confirmation. We haven't heard from the Bank of Japan really moving forcefully to go and set those expectations. When we see that point, I'd expect to see a much larger reaction, both in the JGB market and in the Japanese yen.
Mr. Innes, I would like to get your view on this too. What do you anticipate as the financial market reactions to that?
Yeah, I think the market is going to be less likely to test the Bank of Japan's resolve on intervention if they're starting to reduce their bond purchases as well as signal rate hikes. I think that's obviously going to narrow the differentials between U.S. and Japanese bond yields, which are really the primary driver of where yen is going. However, for any significant move downwards on dollar yen, it's going to really be dictated by the Federal Reserve, as opposed to what the Bank of Japan does. I think the Bank of Japan is going to remain a fairly dovish outlook for the next year or so. That seems to be the case right now. So even small incremental moves on interest rates in Japan aren't really going to make a massive difference. But if the Fed starts to signal rate cuts, which I think they're going to cut at least 1 or 2 times this year, and possibly, who knows, even 3 times, the economy weakens enough, that should be favorable for the yen. So I think we're seeing the high of 160, and my outlook is for dollar yen to gradually appreciate in line with the adjustments in both Bank of Japan and Federal Reserve policies.
So that would be your prediction of what's going to happen to the dollar yen exchange rate in the next few months?
Yeah, I think we'll probably trade back to about 150. I think that once the Federal Reserve Bank starts to signal rate cuts, the yen tends to react quite favorably, as we saw before we moved into this sticky inflation narrative, which seems to be holding the Feds up for cuts. But when we look at the U.S. economy beyond inflation, there are certainly signs of weakness happening, not only in the surveys, ISM surveys and consumer surveys, but there's also indications, the hard data right now, particularly in the employment sector, where it's starting to weaken. And this is going to be very significant. Even Jay Powell stepped up a couple of weeks ago and suggested that, hey, the employment sector is really something we're going to have to keep an eye on. And let's face it, as employment goes, so does the U.S. economy. And obviously, if employment starts to fall, wage pressures start to reduce, and this overall should mitigate inflation pressures in the U.S.
David, what about you? Do you believe that, some analysts were saying that 160 is the final defense line. What are your thoughts on that? And what do you think will be the main factors that will affect the dollar yen exchange rate?
I completely agree wholeheartedly that it really comes down to the Federal Reserve. The Bank of Japan really is a rounding error when you talk about yield differentials between the United States and Japan at this point in time. To go in and exceed 160 on a meaningful basis and potentially push up towards those 170 and even 180 levels that I know that some in markets have talked about, it's really going to have to go and take the Federal Reserve to go and switch around entirely and start talking about rate hikes. Now, that's incredibly unlikely at this point in time. Yes, the US economy has been carrying some pretty strong momentum through. Yes, there are signs that inflation is sticky at this point in time, but that is being largely factored in at this point. So to go and get beyond 160 seems like a bit of a stretch unless it really results in that about facing when it comes to Fed policy. The outlook for me, much like Stephen, is I do see downside for dollar yen, but not meaningfully so. It really depends on how many rate cuts come through from the Federal Reserve, and more so how the global economy fares as well. In an environment where you have Fed rate cuts and a risk-off an environment for markets, there's every chance you'd see undershoot and potentially see dollar yen back below 140 again. But of course, that would rely upon some pretty disastrous times in financial markets and for the global economy.
And Stephen, to what extent do you think the Fed's approach to managing the economy will shape market expectations and influence the currency markets around the globe?
Well, they are the central bank of the world, really, when you think about it, and they're the biggest driver of the dollar right now. Their policy of higher for longer has really inspired a lot of people to stay long US dollars. However, we're starting to see adjustments in the global economy, improvements in Europe and in China, and this is quite significant. If we can continue along with these improvements, we're going to see the euro climb a little bit higher, and we're also going to see the yuan probably stop weakening. Although, that's something on its own right now because we have more yawning differential issues between the US and China. It's a very complicated story because we're also running into a political mess in this election year. And this is something we also have to keep an eye on, is the yen's correlation with other currencies in Asia. The fear that's happening in the markets right now is that weaker yen could mitigate almost a competitive currency devaluation. So we have to keep our eye on the ball here. And I think central banks are very cognizant of this. I think the last thing the Federal Reserve wants to do, although their role is to defend the US economy, not necessarily the global economy, but I think they have to make some concessions as far as these hiking measures, if they do ever think about going down that road, in the sense this could actually stimulate or actually result in a currency crisis. And that's something they really want to avoid on a global basis.
Let me go to David. David, so what are your thoughts on this? So beyond the immediate currency market dynamics, what broader implications do fluctuations in this exchange rate between yen and dollar have for the global economy? What are your thoughts on that?
Obviously, the US dollar is a really key part of that. I know it is the major focal point, but don't discount the other Chinese yuan impact as well, especially for Asian currencies. It's such an important anchor point for a lot of these Asian names out there at the moment. When the Chinese yuan is stronger, that generally will go and help mitigate some of that US dollar strength at this point in time. As someone who sits here in Australia, looking at the Australian dollar, the Kiwi dollar, and a lot of those Southeast Asian currencies, it's really clear as well that in order to go and see meaningful upside and outperformance in those Asian names, we really need to go and see strength start to go and come back as well in the Chinese yuan against that US dollar cross.
By the way, speaking of the Chinese yuan, it's relatively more stable compared with other Asian markets. I mean, if we look at Northeast Asia, Japanese yen, South Korean won, they're basically, all significantly be impacted by the Fed's decision. And if you look at Southeast Asia, I mean, talking about those currencies, the impact is even greater. So what do you think, what are your thoughts on the Chinese yuan? I mean, going forward, do you think that it can stay resilient?
Well, the PBOC is certainly moving down that path to go and make sure that it doesn't weaken beyond the market forces that are trying to go and push it right now. And it is really important. Stephen discussed the competitive devaluation scenario. That is a really key one. If China was to go down that path and look to go and weaken the yuan, then there's every likelihood that it would go and spark a race to the bottom in some of those other key Asian names, particularly in the manufacturing space. I don't think China wants to go and do that, but that's clearly a risk the longer this goes for. So it's not just the Japanese yen, but the South Korean won and other names out there as well that we need to pay pretty close attention to.
As Japan discontinues its negative interest rate policy, what are the responses of the Japanese stock market and financial markets? Additionally, how might central banks across Asia react to the ongoing strength of the US dollar? Join us on BizTalk for insights and interpretations.
Here on BizTalk, we connect the dots, shedding light on the real stories behind the economic landscape. To better understand China's dynamism and the economies and rhythms of business, propelling new drivers of growth.
China.
BizTalk, your window into China and the global economy. Only on BizTalk.
How do you think is the Japanese stock market and financial markets responding to Japan's decision to end its negative interest rate policy?
The weaker yen is really a byproduct of low interest rates here. And what happens there is that if you look at the dynamics in the Japanese stock market, particularly the TOPIX, for instance, half of the board is really exporters. So when you have a weaker currency, it really lends to the export part of the overall narrative. And this dynamic remains very relevant for local investors. Consequently, a weaker yen has attracted foreign investors into the Japanese stock market too, for the fear of missing out. However, one of the things that I do when I'm looking to invest is I kind of look at it the other way. I like to look at markets that are weak, where the currency is weak. Right now, we've got a weak currency in a strong market. The problem with that right now is the returns look okay in yen returns, but when you start factoring it back into dollar returns, if you haven't hedged those dollar returns, you're not getting anywhere near what the returns are, simply because the currency's weakened so much. So you have to be a little bit careful investing in economies where the currency is weakening. Now, the problem is that you're looking at the Tokyo stock market right now at highs. What happens if you start buying now and then the currency weakens? Well, the stock market's going to drop. So it's a little bit of a cat and mouse game is how you want to approach currency and stock market investing. As I said earlier, my approach really is to look at undervalued stock markets with undervalued exchange rates, like Malaysia, for instance, just to use that as an example right now, where you can actually pick up appreciation from a strengthening currency along with appreciation from undervalued stock market appreciations.
Mm-hmm. David, what about you? I mean, as Stephen mentioned, this is a weak currency, strong market situation. What are you looking at?
I've been pretty unimpressed with the way the Nikkei has fared after hitting record highs earlier this year. And that's despite some of the weakness in the Japanese yen that's come through. It really has struggled. Not a lot of momentum, not the same thrust that we saw earlier this year. And talking about the yen situation, if we were to go and see the Japanese yen start to strengthen and strengthen in a meaningful manner, I'd be shocked whether the Nikkei would go and hold these levels. I'd imagine that you'd see quite some big profit taking coming through. It's undeniable, as Stephen pointed out, that the weaker Japanese yen has really helped to go and juice exporter earnings. If you go and take that away and make Japanese exporters less competitive, well, there's every chance you're going to see the Nikkei pull back a little bit. So at this point in time, I think, it is difficult to go and get excited from a foreign investor perspective. I know that a lot of Western investors are hoping to go and get not only gains coming through in the Nikkei, but also some currency pickup as well. I think that's a wish too far. It seems like a perfect world, and that's not likely to go and take place, in my opinion.
Mm-hmm. And also, David, what do you think are the correlation between the Japanese government debt with its, the BOJ's rate policy moving forward? I mean, look at Japan's government debt. It stood at about $8.6 trillion in 2023, more than twice of the country's economy.
It's obviously an area that's getting a lot of focus. It's incredibly large. Out of any advanced economy, the largest share is a percentage of GDP. It has to be managed very carefully, which means that limitations have to be put in place and some parameters to go and prevent a really big increase coming through in yields, because that would obviously be very detrimental to government financing purposes. Look, when you go and look at the relative yield appeal of JGBs, for local investors there in Japan. It looks pretty good right now. If you have to go and switch back out of foreign currencies and try and go and buy like treasuries or anything else around the world right now, it's nowhere near as appealing. JGBs in local currency terms for local Japanese investors look okay at this point in time. So I'm not expecting to go and see a real big backup in yields. And if that does take place, we know that the Bank of Japan will be willing to go and step in yet again and likely go and increase bond purchases again.
And also, surely we know that export-oriented companies would benefit from the yen's depreciation. That's normally the case and part of the contributors to a strong stock market right now. But what are the current exchange rate fluctuations impacting trade relations specifically between the US and Japan? Stephen, can I start with you, please?
Yeah, it seems that Japan is one of those countries that gets a pass from the US. And I think that's simply a function of the amount of bonds that they buy. What I mean, a pass, like the weaker yen, doesn't really raise red flags at the Treasury, simply because they seem to have very comfortable relationships between those two countries. So they're sort of a little bit safe, unlike a lot of other countries around the world that would attempt to weaken the currency. They would sort of raise red flags at the Treasury. On the other hand, my view here is that really, from a Treasury perspective in the US, they would want the dollar to weaken. The reason being is what David mentioned earlier is the fact when the dollar starts weakening, people can actually invest in their foreign currency into the US economy with these bonds and actually pick up gains from the currency investment. Dollar weakens, they can get stronger returns from their currency investment. So this is something we have to look at as an overall investment strategy, that we just don't always focus on the rates, but we also have to focus on what the currencies are doing in situations like that.
David, what about you? What kind of potential implications do you think this will have for the longer-term economic cooperation between Japan and the US?
Stephen explained and described it very accurately there, calling it a free pass as such. The fact that you've had Finance Minister Suzuki in Japan meeting with Treasury Secretary Yellen and also the South Korean finance minister counterpart really suggests that there's a bit of coordination going on right now. So in the near term, there's no real dramas that I think can be associated with this. If we're to go see that the Japanese would actively seek to go and weaken the yen further and improve that competitive advantage, then there might be some issues coming into play. And then, of course, we talk about the federal election there in the United States later this year, and the two presidential candidates. It looks like clearly that might change as well when it comes to some of the way that what Japan's policy is right now and what some other regional players in Asia are doing are seen through the eyes of the US government.
.360-degree profiles of industry movers and shakers, tech mavericks, and policymakers. We drill down on their success. We ask how they set strategy and how they navigate in an increasingly competitive market. Real talk, real business. Join the conversation. BizTalk, only on CGTN.
Stephen, let me get back to you. How are central banks across the region adapting their monetary policies in light of this ongoing strength of the US dollar and, of course, its impact on Asian currencies?
Well, they're really between a rock and a hard place. For the most part, I think a lot of central banks would like to be dropping interest rates. I think, stimulating the economy. I think a lot of economies are struggling in the region simply because Chinese economy hasn't been firing in all cylinders. And lots of the Asian economies really are very, very closely connected. For instance, we looked at the Malaysian economy, which has very, very strong trade ties with China. Central bank wants to cut rates, but unfortunately they can't cut rates because of the the ringgit is so weak right now. So they have to defend the ringgit to an extent by keeping rates up. So it creates this vicious doom loop circle, not really a doom loop circle, but it's a negative feedback loop. And unfortunately, until until the Federal Reserve starts to drop interest rates, I think, yeah, local central banks are pretty much stuck right now because of the weaker currencies.
What about you, David? What do you think? What are your views on this tricky situation? I mean, those central banks in Asia are trying to balance out, between alleviating currency pressures and uphold economic stability.
Yeah, rock in a hard place. It is difficult at this point in time, and they do run the risk if they look to go and ease policy settings at some point and result in weakening their currencies, of importing more inflationary pressures coming through. The hanging out for the Federal Reserve to go and start to signal that first rate cut coming through for the cycle. A lot of people are expecting that would already have taken place this year. Clearly, that hasn't taken precedent at this point. Whether it's likely to go and arrive later in the year or even maybe early 2015. But that is going to be the real key thing, because at this point in time, at the moment, we're seeing a lot of pressure. We're seeing those sporadic interventions coming through to go and try and mitigate pockets of local currency weakness. For the time being, that's working, but it's only a finite timeline. Currency reserves can be depleted very, very quickly in some particular nations. That's going to be the key one. If the Fed doesn't go and start cutting rates, doesn't signal that rate cut is coming through, and that's the risk that we will run there, that we might see some real unhinged moves in some of those local currencies in Asia.
What would be the on top of your suggestions to those central banks across Asia?
Look, any nation, I don't want to go into specifics really, but it really comes down to any nation that does not have significant foreign currency reserves in place, or look to go and peg their currencies or something on those manner, don't have that freely floated. That's when you start getting those pressures going and alleviate on occasions. So that's the ones that I'd be looking at. Those that have got vast sums of foreign currency reserves accumulated to go and utilize in a much stronger position at this point in time to go and ride out this bout of US dollar strength.
What about you, Stephen? What would be your top advice?
I tell them to get on the phone and call Jay Powell and tell him to drop interest rates. Unfortunately, that's not going to happen too soon because the Feds are dealing with inflation narrative right now that doesn't seem to be mitigating as quickly as they expect. But as it stands right now, the difficulty is trying to run your economy independent of the Fed as far as interest rate policy goes. And that's a problem, getting back to the currency situation again. So they're going to have to be a little bit more wait and see approach because they have to really wait until the Fed initiates that first rate cut before even thinking about making policy moves.
How are the fluctuations in the exchange rate between the yen and the US dollar impacting the economies of both countries, as well as the strategies of enterprises and investors? Who stands to benefit from seizing opportunities in this financial climate, and who may face challenges? Gain detailed insights into the current economic situation and market trends from experts exclusively on BizTalk, only on CGTN. And also, other than those challenges and uncertainties, do you think that this volatility of the yen-dollar exchange rate also present opportunities for investors?
It presents carry trade opportunities because we're in a market right now where volatility is actually quite low in the currency markets. It's not really an aggressively whippy market here. So what you're finding is a lot of people are still using the yen as a funding currency, and why not? You can just go long dollar yen and collect 5%. So it's not a bad trade when you think about it, provided the market doesn't come off. But the popular trade that Japanese investors go to is Mexican carry trade, Mexican yen carry trade. And this is very, very popular in currency markets right now. I always caution my traders and investors about collecting nickels in front of a freight train when the freight trains are actually slowing down, I should say. The only reason being is that everybody's in this trade right now, and the problem we have right now is if all of a sudden the yen starts to strengthen, this could be a bit of a nightmare for those investors that are potentially in carry trades. I think the worst situation that we could see right now in that trade is the U.S. unlikely running into some sort of systematic meltdown problem or a recession that would necessitate the Fed Reserve to cut interest rates aggressively, and money would go flying back into Japan, and that would be a real horror story for this low vol environment. And that's something we have to keep our eye on, unlikely as it would be, but it's always something that races in the back of my head every time I've loaded up on the carry trade.
David, other than investors, what do you think are the opportunities presented for enterprises? I mean, which sectors should be looking at, trying to grasp business opportunities in this market?
Well, exporters, we've talked about that extensively, about how they've benefited from the weaker yen. But anyone who's importing could probably go into test, and that would include some of those exporting names, would not necessarily be enjoying that weakness in the yen and the costs that are coming through. Obviously, the Bank of Japan probably wouldn't mind that too much when it comes to trying to go and pass on those cost increases to help fuel that inflationary environment they're trying to go and foster there. But at this point in time, Stephen was exactly right when it comes to those carry trade flows. The risks, in my opinion, are very asymmetric. Yes, you can go and get small incremental wins along the way. But if there was to be a change in the carry trade, if there was to be a meltdown of some sort in the US economy or a global-wide problem, that would go and run the risk that you'd see big unwind, a lot of money going back into the Japanese yen. And any of those modest gains that you've been collecting on the way would be wiped very, very quickly. We've seen that in other examples of market turmoil in the past, and that's the risk that we have another scenario like that take place again.
So, gentlemen, my final question to you. I mean, I already asked you this question talking about what do you think would be investors should be looking at this moment. So if I want you to make your suggestion and a piece of investment advice, make it brief and short concerning the current and potential future situation of the Japanese yen, what would that be? Can I start with Stephen, please?
Yeah, I think trading the Japanese yen is very challenging because of the negative carry and trying to time the operations when the Fed Reserve are going to start cutting interest rates. My position is just to look at Swiss yen, for instance, right now, and sell Swiss by Japanese yen. They're too low carry currencies, and if the yen starts to really appreciate, we should see a fairly big drop in that that low yielding cross trade. And that'd be something that I'd advise. And then once the definitive signs start to show that the Fed is pretty close to cutting interest rates, that's when you'd probably want to jump in on the short dollar yen positions.
And David?
Unfortunately, mine are very similar. And on a longer term perspective, where you see the dollar yen where it's trading at this point in time, unless you have a very strong inclination that the Fed is likely to go and hike rates again, you feel pretty comfortable getting short around about the high, like 156, 157 potentially at this point in time. You look at that, you're potentially losing 300 basis points or 300 pips to go and make a whole lot more on the downside. To me, it just comes down to when that Fed signals. Of course, we've got a very important inflation report as well later on this evening. That could go and be the start of that catalyst. But when that moment happens, I think it'll be like a trapdoor, and the move will be pretty abrupt, and that will be an opportunity for investors.
Well, that was a productive discussion with Mr. David Scutt and Mr. Stephen Innes. Thank you so much for joining us on this episode of BizTalk. I'm Lily Liu. Till next time, bye for now.